Thank you for choosing this Analyst Insight podcast from the Information Security Forum. My name is Mark Ward, and today I'm talking about cyber insurance with Dr. Emma Bickerstaffe, who's written a briefing paper on the subject that's going to be released very soon. Hello, Emma.
Hi, Mark. Nice to join you today.
Also joining us is Simon Meech, who is cyber practice leader at insurance broker BMS. Hello, Simon.
Hi, Mark. Very pleased to be here.
Thanks for joining us, Simon. So the last month or so has seen quite a few events in the cyber insurance sector. We've had the attack on the Colonial Pipeline in the US and some legal changes as well. The US government said it is going to start treating ransomware attacks, extortion attacks, like terrorism, going to be investigating them, some of them like it does significant air crashes. So there's going to be a lot more official attention on this, but certainly for the last year or so, it's been top of mind for a lot of organizations because there's been some market changes that have driven organizations to make some significant decisions. And a lot of that is because of the issue of what's known as silent cyber. So Emma, I don't know if you can give us a quick overview, quick definition of what that is, and clues into why that's become such a big issue.
Sure, Max. So silent cyber is definitely some good insurance lingo that I was unfamiliar with until I started this briefing paper, but I've learned a lot about it over the past month. So silent cyber is where you have cyber cover, but it's not affirmatively or addressed, either expressly covered or excluded in particular lines of insurance. So there's been a lot of regulatory attention both in the UK, the US and elsewhere about what does this mean, because obviously if you do not specifically address cyber risks within a cover, but you don't either expressly exclude it, does that mean that you do have cover for a particular event which is triggered by a cyber event? So this creates a little bit of ambiguity when you do come to making claims as to whether you can rely on a particular line of insurance. So Simon's obviously been a lot closer to this topic, so we'll be able to give us a little bit more clarity around silent cyber. And
So when it comes to silent cyber, a lot of organizations, I guess, were trying to cope with a cyber attack via their other lines of insurance, just that they may have on just business interruption or something like that. And I guess that I think the last year or so, there's been, let's say, some market not quite regulatory changes on this. So Simon, is that the case? That's why the decisions have had to be made, why silent cyber has become an issue, is because organizations can't rely on those attacks being covered via other insurance policies they may have.
Yeah, absolutely. That's certainly one area of it, is that the insured themselves wasn't able to rely on these other lines of business to protect them from a cyber attack necessarily. But actually, I think the regulator as a whole, the PRA and Lloyd's, after kind of looked at this problem more also from the insurer's side. And from the insurer's side, if they have, let's just focus on property, for example. There's a lot of property risks out there that do not mention cyber. They don't mention whether cyber attacks are included or whether they're excluded. If we did have an event in the future where we saw a large-scale cyber attack hit multiple organizations around the world in one go and cause property damage, the ambiguity would be huge across the entire market. This wouldn't be just a single case. This would be multiple cases in which insurers that hadn't priced for, maybe they hadn't considered the fact they may be covering damage from a cyber attack, would suddenly be on the hook for many different risks, all claiming at the same time due to one cyber event. And so it's that clarity for the insurers, but also the insured, to make sure that they understand, they need to be buying specific cyber coverage if that is what they want.
All right. Okay. So it's both sides then. Now, I didn't quite appreciate that. So on the one side, you've got organizations who have to make a decision about this, maybe get that explicit policy in place. And on the other, like you say, insurers needing some clarity over what exactly they're being asked to cover. Because I suppose the other side of this is that the cyber insurance market has been through quite a few changes recently as well. I know premiums are rising. So Emma, again, is that what's driven the ISF to do this paper? Is just there's a lot of decisions to take, there's a lot of history to rehearse, and people need to be updated about that and the types of things that they can expect.
Yeah, definitely. I think over the past 2 years, there's been quite a shift in the cyber insurance market, both in terms of organisations looking to cyber insurance when they might not have previously, due to obviously the rising numbers of cyber attacks and the severity of cyber attacks, and actually seeing the exposure that organisations have and the impact of incidents in terms of the financial losses that they incur as a result. A lot of media attention on attacks, you're then able to really see what the implications are for you as an organisation, and looking to protect your risk. Even you might have obviously a lot of excellent security controls in place, but you will also can't prevent nation state actors who have a lot of motivation and intent. So that's one reason. Of course, there's been a huge number of ransomware attacks recently that have driven people to look to cyber insurance. But the actual products available have changed a lot, and I think the silent cyber has contributed to that, because you're not able to rely so much on other lines of insurance to cover you. People are looking to cyber insurance, standalone cyber insurance products, and there's been quite a lot of development in what's available. But there's also a bit of a tumultuous market because of rising claims. Insurers are running at a loss, particularly with ransomware claims, so that's causing the premiums to rise, and so having to really look closely at the type of questions that insurers are asking as well. So I think it's interesting to see how we're playing out at the moment. The reaction of the market generally has been to explicitly exclude cyber cover from other lines of insurance, and that's going to be interesting then to see what are the gaps in coverage that are arising as a consequence of that.
All right. So Simon, from the market side then, from the insurer side, is that what you're seeing? I guess this is a decision organisations have had to make, and have you guys had to change the policies as well in terms of, I guess they had to be more explicit, but I just wonder if the organisations are coming to you with the right questions, just whether sort of they know what their exposures are, or whether that's part of what you have to help them with.
Yeah, so I mean, a traditional cyber policy hasn't necessarily changed that much in light of the silent cyber issue and the new regulations, but it is about kind of the gaps which are now left in other lines of business because of the exclusion coming in, and how does that fit in, because not all of it fits into what we would deem a traditional cyber insurance policy, which now means there are other slight variations of cyber insurance policies out there where you've got property damage, perhaps bodily injury included, where that was just never, or certainly wasn't the usual case before. So that's the change that we've had to look at, really, and it's about adding these, creating new policies almost to fill these gaps, which means from the insured side, it looks a lot more complicated. They're not looking at just their property policy now; they're now looking at their traditional cyber policy. They're maybe looking at cyber property damage policy. So there's a lot more to think about, and there's a lot more gaps to consider.
So cyber insurance then, I guess, has to be considered as part of that panorama of insurance that organisations have. I mean, I guess it doesn't stand by itself, not least because the effects of an attack, I suppose, could be very widespread.
Absolutely, yeah, and that's it. And because it's so widespread, this is where the complexity comes in, because the rules and regulations have kind of been brought in to multiple lines over the last couple of years. Almost every 6 months, they've affected more and more lines of business. So we initially started with property, but we're looking at accident and health. We're looking, at marine. They're looking at D&O. They're looking at PI insurance. All of these areas, which some are affirmatively including it, but a lot are not. And so now we're looking at events for every single line of those business, and looking, well, what events now fall between a cyber policy you may have purchased and that policy, and where can we bring in a broker to then kind of round that all out? Where can we put it in? Can we get it in that other line of business? Can we add it into the cyber?
Emma, if I can just come to you as well, do you get that sense from members that it has got a lot more complicated, and they, like I say, there are gaps there that they perhaps haven't been aware of before now?
Yeah, I definitely think it's become a lot more complicated. It's interesting the approach Lloyd's took when they mandated that insurers either specifically include or exclude cyber events from the lines of insurance, having a 4-phase approach across so many different lines of insurance that I, for one, didn't even think that so many lines of insurance could actually potentially contemplate cyber risks. So it's interesting to see that there's just such a huge package, as you say, a panorama of insurance that you need to think. So organisations really, when they come to cyber insurance, are having to work really closely from their CISO answering a whole raft of questions, from their risk manager, from their procurement team, their insurance manager, and of course the CFO, because we obviously have some hefty premiums now to pay out. And so it's complicated in terms of making sure that you are covered holistically and you're considering all the various different risk scenarios that could happen and what's most important, and prioritising the cyber risks to your organisation that you need to really make sure you do have included within your cyber coverage, and right through to, do you have the right limits in place, and having to build towers to actually have those limits. But it's interesting because I don't know Simon's view on this, but why have insurers taken the approach of excluding? Is it because if you actually affirmatively include cyber, you're going to have rising claims because people suddenly now know that you can use this particular line of insurance to cover a particular event? Or is it a sort of the motivation is to really push people to actually be looking towards a standalone cyber insurance policy, and then to sort of increase the demand in the market for that? So yeah, keen to hear what you think on that, Simon.
Yeah, I think it's a bit mixed. First of all, looking at insurance on the whole right now, most lines of business are, most premiums are getting more expensive across the board generally. It's not the case for all lines of business, but generally right now, prices are going up. So if you're suddenly affirmatively including a particular risk, which perhaps you didn't think you were covering before, then you need to charge for that. So you're going to increase the rate even more. Now, that client may have thought that they had it already. So they're thinking, wow, that rate's going up even more, right? So it's in its most simplest form, it's making them look less competitive, right? It's easier to exclude it, not charge for it. The rate increase doesn't look so bad, perhaps. So that's one case. But I think the second case is a lot of underwriters in lines of business and property and marine, wherever they actually look at this and say, well, this is a wholesale change in the market. We are completely changing the way that we view cyber risks. And is that individual property underwriter making that decision the right person to be making a decision about cyber risk? How much do they know about cyber risk versus a cyber underwriter who is looking at the problem, has been looking at the problem for many years? And so I think even it is, in a way, you could argue it is actually quite a sensible decision that in a lot of lines of business it's being excluded and moved to the cyber market. I wouldn't say that's the case across all lines of business. I've got a few nuances to that, but in general, I think I completely understand why they've done that.
Yeah, but it sounds like a very complicated situation then. If you're someone buying this, and like you say, suddenly you're going to see your premiums going up for something that you thought was covered, and now I guess you've got to do that explicitly, and then presumably you may have to do more work as well, because certainly the number of attacks that have been I would imagine had a significant impact on the insurance market, and a lot of insurers have withdrawn because it's really expensive, and I guess the premiums, the claims are starting to rise as well. So is that a part of what's going on here as well? That's sort of the other side of it, that just the number of attacks has driven some of this as well.
Yeah, and look, that was why the regulator looked at this in the first place as well. Not only was it the ambiguity, but it's ambiguity around a topic which was only going to get worse, in the sense of risk, good or bad, that the world is moving to a more technologically advanced age, and cyber risk is only going to grow. And so this problem of ambiguity was only going to get worse. The risk behind that ambiguity was only going to get worse. And so better to kind of deal with that now. And so I think that it's completely in line with that response that so many insurers would turn around and say, yeah, we're going to exclude this then. This should go to the cyber experts, the people that perhaps can understand aggregation risk. They can understand, whether one network is connected to another. A property underwriter may just look at it and say, all of my locations for this insured are under risk if there's a cyber attack. A cyber underwriter may look at it and say, well, actually, what controls do you have in place to say that this location is on this particular network and that network is entirely segregated from this network? And therefore, one cyber attack wouldn't necessarily affect both locations. And so that nuance that a cyber underwriter can give it, should be to the benefit of themselves and to the insured.
Yeah, and I guess, Emma, that's some of the advice I guess you're drawing up is just look at it in the round, those nuances, who you need to talk to, and make sure that the complications, the complexity of organisations are represented well to those insurers, so they do get a sense of what your actual risk is, because I guess that's the starting point, knowing exactly how exposed you are.
Absolutely. Like, it's been quite surprising actually having so many different conversations over the past month, and the resounding advice is understand your own cyber risk. And that seems very simple advice, but it's surprising actually how many brokers and insurers have actually seen that organizations come to them and they're looking more to what is the competitor buying, or ticking a checkbox because they need cyber insurance for a contractual obligation, rather than actually truly getting to grips with what your actual cyber risk is, what's your residual risk, and to what coverage do you actually need to cover that, and having a real firm grasp of what security controls you already have in place, and how that does impact the way in which insurers will quantify your risk, because obviously the better protected you are, the more prepared or more resilient, and the more mitigations you already have in place to protect yourself, the more an insurer will want to buy your risk for a better price. So it's only in your favour to have a really solid security posture, and at the same time to have clarity on what coverage it is that you will get, and does it actually meet the coverage that you require. And so I think, like with the cyber thing, the interesting thing for me is around physical damage, because obviously cyber insurance was initially created to look at that intangible damage that is caused by a cyber attack, but we have OT, we have Internet of Things, and the merge between intangible and intangible is kind of more acute than ever. So what do you do, and how does the cyber insurance go to develop to account for the actual damage that might be caused to your equipment and your computers, your sensors? What happens when you have in your OT environment something that's triggered by a cyber event? So it'll be interesting to see what happens there.
Yeah, I think that's definitely an interesting aspect of this. Like you say, before now, cyber attacks have been about locking away data or destroying data, and there's no physical damage is done there. But increasingly, as Simon said, just the world is getting more interconnected and technological, and there's more stuff that's just becoming more vulnerable to these types of attacks and the damage. Because certainly there's been, obviously, there's been some attacks on various manufacturing plants and things like that. Certainly Norsk Hydro, and as well sort of Maersk, I think, as well, suffered physical damage to plants and manufacturing facilities thanks to cyber attacks. Other advice we're giving people is this is something that you have to keep an eye on. You can't just sign it and walk away. You have to be involved with it, keep on going forward. Is that reasonable, Simon?
Yeah, absolutely. And certainly, I'm glad we're kind of heading towards a bit of a focus on that property damage area, because of all the lines of business where these cyber exclusions or these cyber exclusions have come in, I'd say that property damage is the area, and property risks are the area where there is the biggest gap, and actually there's the most amount of nuance around it, and where a client really needs to sit with their broker and really get involved into what the policy is actually covering, because it isn't as binary as how we're kind of talking here in terms of an exclusion or affirmatively covering. The exclusions, there's about 50 out there already since this all came in, and certainly on the property damage side, there's a multitude of different ways to look at it, and a lot of clients need to look at their cyber risk now into two categories, because this is what those cyber exclusions have done, and the categories kind of fall down to cyber attacks and cyber incidents or accidents. And so the accidents could be a system failure, it could be a human error, pressing the wrong key, it could be during updating or patching your systems if something goes wrong, and that would all fall down the side of a cyber incident, while a cyber act would be anything that was an attack, some sort of a malicious event against your organization. And the exclusions now really put a clear definition of the two and really to handle the two in different ways. And it's those cyber attacks, which the majority of the exclusions are almost entirely removing. Any sort of coverage for cyber attacks is what's being removed. And in the property damage space, that's great, because that is actually something that the cyber market is willing to look at. They're willing to look at covering property damage and the resultant business interruption from those cyber attacks. The area of nuance comes in, what do we do about these cyber incidents, these accidents, right? Because you have the cyber market on the one hand that says, well, yeah, we are absolutely trained and ready to understand controls against security risk and, knowing who the attackers may be and how prevalent they are at the moment and so forth. But we actually don't have models and don't necessarily have any more understanding to random events, random human error events or random system failure events. Actually, the property market, who's had years and years and years of experience, and actually, since they've been covering all risks, they have been looking at random events, both to non-systems and systems. And so the cyber market almost believes the property market should be covering those, and the property market almost believes the cyber market should be covering those. And what we have is a number of different exclusions where handle cyber incidents to a different degree. Some will completely remove them. There'll be no coverage whatsoever. Some will offer resultant fire and explosion damage from a cyber incident. Some will go further than that. And so while talking with a broker, it's incredibly important to find out exactly what exclusion is on there. What is that exclusion doing? And how much of that that's been excluded can I get back through a different product? Because in some cases, it may not be all of it.
Right. Yeah, that's interesting because I suppose we're underlining how complicated it all is, and I guess again that's what we're trying to be here, sort of guide through some of this and the decisions organisations need to take, CISOs, people need to include, and just that discussion they need to have. But I guess the pressing point is there's decisions that need to be made here, and organisations have to make those decisions.
There's decisions, and definitely the resounding feedback that we've had from member organisations who are currently going through renewing or looking to purchase cyber insurance as a first-time buyer is the importance of having a really good broker who's familiar with the market and understands the various nuances and intricacies that Simon's been covering. And the assistance from a broker goes right from the very start in terms of looking at what your risk is, how do you prepare for a risk dialogue, what do you need to be thinking about in terms of coverage, where are the particular exclusions that you might not even be aware of. And I think that's the thing that's coming up now, is that organisations definitely just weren't aware of the extent to which cyber might have been covered in other lines, but now that's actually in effect contracting their coverage because of these exclusions, and what are the gaps that they might have been unforeseen, unexpected, or just not thought about, but actually you might come to rely on when something does happen and you need to claim. So having a broker there to be able to really dive into those conversations, and there's not a stupid question in this particular case. It's a lot of money that you're paying out for a premium, and there's even more money that you might be paying out if you don't have cyber insurance and suffering an incident. So making sure you actually, you're asking for approval from a board for an investment that you're making. So you need to have a really good understanding, and having that support of a broker, I think, it really is vital.
Thanks, Emma. So Simon, how far in advance should you be engaging a broker then? Because clearly it's a key relationship that organisations need to set up.
Yeah, with these changes that are coming in, I would just say as early as possible. I mean, 6 months would be great, but really there's no limit. It should be as early as possible before your next renewal, because what you don't want, and we have seen it where people engage with their property broker, they get all the way, and then within that last month, someone mentions what the exclusion really does, and then they're a few weeks away from renewal before they're actually exploring these other areas of coverage in order to help cover that gap created by the exclusion. The earlier you can engage, the earlier you can speak to a cyber broker in particular to discuss the various lines of business you buy, what the expectations are of what type of exclusion may play out and may go onto those policies, and what the alternative options are. Because cyber brokers, they can get very good rough indications for what this stuff costs to you nice and early. Because if it's a new purchase for a board, that's obviously some discussion that they may want to be having long time in advance, and exploring exactly why they may be looking to invest in this new type of coverage. So as early as possible helps with no surprises, and will really get you confident that you've covered all the angles going into your renewal.
If you are looking at cyber insurance just as a first-time buyer, what is your sort of elevator pitch to the board?
Yeah, wow. The elevator pitch to the board is that, frankly, this stuff is, on the one hand, for the organisation itself. The organisation needs to understand what is going on around the world right now, and the increased threat and the increased risk. There are actors out there that will always be able to penetrate your systems, no matter how good your systems are. Whether you're a massive, large multinational, you still have nation-state actors that will easily be able to penetrate your system if they chose to target you. And so controls are great, and they certainly bring up the the low bar that perhaps the organization has if you continue to implement more and more controls. But frankly, an event, if it is going to happen, will happen. And actually, you need to prepare yourself for what does your balance sheet look like when it does? Do you have the expertise inside the organization to handle the event as it is happening? Or would it be better to work with an incident response team as provided by a cyber policy that then can handle that situation, can give you some peace of mind that the situation will be handled by experts that have dealt with thousands of other breaches or incidents similar to what you may be going through at that time?
You just actually reminded me there, and this links in nicely with our conversation. I had a chat to an organisation just the other week, and it was for this very reason of silent cyber, that they were looking more to a cyber standalone policy, and that they did have an incident a year or so ago. It was actually covered, but they now, because of the property damage being excluded from the silent cyber issue, they're having to go back to market and going through the underwriter risk dialogue process at the moment. But they are considered a high risk organisation due to the type of data that they have. So it's seeing any insurers sort of veer away from sort of high risk industries. Is that something that's kind of, as people are now having more of a demand for cyber insurance? On the other hand, we also have insurers who are perhaps a little bit more reluctant because of the rising risk exposure. And if you have a particular high risk industry, how does that sort of play out that you're seeing from your end?
Yeah, it is becoming incredibly tough for certain industries. Municipalities, government organizations, schools and education, traditionally industries that are seen to have tight budgets and therefore potentially cutting corners on their security. And I think these are the organizations that tend to have those fairly low bars in terms of security and therefore a much higher risk. And it's actually, I'd say it's those organizations with those sorts of risk profiles more so than those that necessarily have particularly highly valuable data. You know, hospitals have always been a particular issue for insurers. They're holding very, very sensitive information, but because they're holding such sensitive information, you know, we actually tend to see some better controls and better security from them. But government organizations, charities, schools, education, they are problem areas at the moment, and the market is cutting back coverage, increasing rate because they are seeing these claims play out. And so to those organizations, they do need to be investing in cybersecurity. They need to be demonstrating that they're best in class when they come to get insurance. But also they do need to be buying insurance as early as possible. Insurers tend to, in the large corporate world, they tend to support organizations that they are already insuring. So if they are insuring you now and your risk, you know, massively increases in the next year or two, you're still more likely to get coverage from that from the insurer than you are if you're coming to them as a new risk in a year or two's time when your risk profile has enlarged. And so the earlier you can buy insurance, the earlier you can build a relationship with your broker and the insurer, the more favorably you'll be looked upon when perhaps times get tougher.
Excellent. Thank you, Simon. Thank you, Emma. Thank you, everyone, for listening. You can find more podcasts on the ISF podcast channel or at securityforum.org, where you can also learn more about ISF research, tools, and guidance.